Okay, let's begin. Welcome and thank you for joining RegCentric in our webinar network series. There's been a wild ride of embracing technology and the flexibility it has provided of late, especially for us to deliver these content series. We hope you are enjoying our increased lineup of data, regulatory, finance and risk networks, and that they are providing value add to your role and thought space. In today's session, a veteran of the financial services industry will provide a commentary on forecasting credit losses during and post-COVID-19. But first, let's do a little housekeeping. To ensure the best experience for yourself and other guests, please put your microphone on mute when you join the webinar and ensure it is on mute during the entire length of the webinar. You can raise questions to the speaker using the text box to the right of your screen. These questions will be answered at the end of the session. Please also participate in the polling questions that will be raised on screen during this webinar. At the end of the webinar, we will discuss the polling results too. Word of warning, be quick to answer these questions. With no further ado, I'd like to introduce David Williams. David is a finance heavy with over 20 years experience in the banking and financial services industry in Australia. He's worked in a variety of roles during his time, including regulatory reporting, business partnering, financial control, and some leading names in banking and finance. More recently, he took a leading role in a transformation project for a big four bank. At RegCentric, David supports our banking clients to effectively navigate the complexities of regulatory change in finance and risk. Please join me in welcoming David to take us through a commentary of forecasting credit losses during post-COVID-19.
Thanks, David. Welcome, everybody. The outline today is looking at primarily four areas. A quick refresher on AASB 9, stress testing and why it's important, assumptions that banks have made on forecasting ECL, and a brief look at capital management. We turn to the first area, the journey to expected credit loss norm. The new accounting standard has been a long time coming. We're now 11 years on from the GFC and facing a new crisis, which already has its own nicknames. The Great Reset, the cost drop, the transition, which brings the implementation of the new accounting standard into critical focus. This timeline sets out the key events in this space since the GFC, including the VAR framework, guidance and discussion papers issued by APRA, setting out their expectations in relation to APS 220 credit risk management. In recent events, APRA issued a discussion paper in the draft of changes to APS 220 and sought submissions. APRA published a response to those submissions in December 2019, which proposed changes in two. First one being credit risk management, including credit standards and the ongoing monitoring and management of an ADI's credit portfolio over the full credit life cycle. And secondly, asset classifications and provisioning, taking into account updated BAL committee on banking supervision guidance, on the focus being on credit-related matters and recent changes in accounting standards. It appears as though APRA is aligning a lot of the elements of AASB 9 with APS 220. It's expected that a new APS 220 addressing credit market risk will be issued late 2020 by APRA. We turn to incurred versus expected loss. Post-GFC, the Australian government introduced the deposit guarantee, which helped protect our at the time. Therefore, we were not as hard hit as other countries, and APRA revised its guidelines requiring a general reserve for credit losses. Nevertheless, the impetus for revising AASB 9 to calculate loan provisions was based on the fact that the previous accounting standards provided for losses to be provided on an incurred basis. There has to be solid indicators of bad debt based on past events, those loan loss events, before a provision could be booked, which coming out of the GFC indicated there were a lot of inflated loans on balance sheets worldwide, particularly in the US where buyers could walk away from their properties. Criticism is the provisioning was delayed prior and during the GFC. New AASB 9, however, requires a loan loss provision or ECL to be calculated regardless of whether a loss event has occurred. It is forward-looking provision, with the key differences to the old standard being and earlier recognition of loan losses, a forward-looking approach, and enhanced disclosures. We move on to the model itself. There's a three-stage model for impairment. So a key concept introduced by the new standard is where there's been a significant increase in credit risk since the initial recognition of the loan. This must be assessed each reporting date. AASB 90 introduces a three-stage model for entities to consider. Under stage 1, where there is no increase in credit risk since initial recognition, the ECL should be calculated as the expected over the next 12 months. That is, using a 1-year probability of default. This is a key differentiator to those loans in stage 2 and stage 3, where once a significant increase in credit risk has been assessed, the ECL needs to be calculated on a lifetime basis. That is, using a lifetime probability of default. However, noting that if conditions change, for example, the credit risk decreases to that existing at the date of initial recognition, the ECL can revert to being calculated based on expected loss over the next 12 months. It's important for banks to have a process to define what constitutes a significant increase, reasonable and supportable. So the most influential Chief Transformation Officer is COVID-19. I think it's fair to say you may have already realised the multiple requests for data from the regulator and additional queries from internal stakeholders. It's certainly a dramatic change for the industry. But also in the way you're running a business, you need more granular information and reliable models. Let me take you on a journey. So there's 5 key components to the stress testing platform. Sound judgment is going to be paramount across your ECL models, given the numerous factors to consider. First of all, what a significant increase in credit risk. Some elements to consider, quantitative elements. Scorecards or risk rating systems after setting thresholds for determining what constitutes a significant increase in credit risk in terms of that score rating. Backstop indicators, internal and external. So internal price indicators for risk, what you're currently charging as a credit spread or premium that you would have charged for a similar risk previously. If that's increased, that's a pretty good indicator. Looking at external indicators, significant change in the value of collateral, supporting the obligation. Also noting that the current treatment of loan deferrals for COVID-19 is not treated as a significant increase in credit risk. Looking at PDs and LGDs, key parts of the expected credit loss calculation, how they will be justified, particularly for retail customers where you don't have rating agency data to rely on. It's always a challenge in smaller banks with minimal historical loss data on what to use. Consideration on the forward-looking variables and factors will be key to align with the customer exposure that you bank. The forward-looking variables need to be relevant to your organisation's exposures and its risk appetite. Being able to adapt to changing scenarios and determine what ratings you're going to face, particularly as COVID-19 evolves in the coming 6 months, is your severe downturn weighting relevant if a vaccine is distributed earlier than expected? Is your model flexible enough to adopt this quickly? Take advantage of a release of your provision and ability to lend more. What additional overlay management, intensity of exposure to specific industries and demographics? The models need to be flexible and adaptable to change. We move on to APRA's view on stress testing. To take a holistic view, it is clear what APRA's view is in embedding stress testing into your banking process. As an integral part of risk management, stress testing helps enhance the readiness of institutions to withstand adversity by improving their understanding of risk, enhancing capital management, informing recovery planning, and reducing the likelihood of failure and resolution. In February this year, APRA released findings from stress testing assessment of ADIs. It highlighted the small ADIs, those that are in the total assets ranging from 3 billion to 25 billion, but they generally did not have specific frameworks for stress testing, and instead relied in part on various risk specific management frameworks, and internal capital adequacy assessment process documentation. The scenarios and stress parameters were typically designed with less sophisticated considerations. For larger ADIs, typically had broader engagement across the organisation in their stress testing activities, and generally made better use of stress test results and used stress testing in a wider range of decision making than those in smaller ADIs. So really, they've expanded it to look at in terms of liquidity, earnings, and capital management, not just for their. The role of stress testing appears much less prominent in smaller ADIs, where internal stress testing results were generally only used for validation of their main internal capital targets. They typically did not have well-defined risk appetites around their capital adequacy. I've added the link in there to the assessments and the findings that APRA had, if anyone wants to look that up after the presentation. If you look at the importance of the assumptions and the modelling, another key concept for AASB 9 is the incorporation of a forward-looking assessment of expected credit losses. COVID-19 will undoubtedly test the most robust of forward-looking ECL models. Who has a crystal ball? You will need one. It is therefore important that the framework of the model is built within the following 4 criteria in mind. A top-down approach, looking at macro factors. A bottom-up approach, taking into consideration a granular look across industry sectors. And this will also impact on employee occupations. It's important to get clear sight of that. The acknowledgement of the unknowns. There are numerous factors to consider with COVID-19. It needs to be flexible enough to do rigorous scenario and sensitivity analysis. Models will require continuous refinement as new information, and you will need to be able to probability weight those scenarios. Let's look at these in some more detail. So as I said, if you look at the top-down considerations, it's recommended that you only use 3 or 4 of these. Generally, unemployment, GDP deterioration, interest rate, housing prices, they're the ones that were predominantly used by the banks. Looking at, a number of those considerations, when will unemployment peak? Interest rates are going to be lower for longer, and there's going to be bigger government and public debt. Will there be a V-shaped recovery or prolonged downturn with a slow recovery? That's going to be critical to model that in terms of how long you think the recovery is going to be. Consumer and investor caution, and also the trade implications. Export, import, US-China relationship is paramount, and therefore the Australia-China trade relationship as well is a consideration. Secondly, looking at the bottom-up considerations, leading indicators. Take a granular look at the sectors impacting your bank exposures. What leading indicators will give you an insight to the trouble spots, and therefore sectors you are overly exposed to and may require to de-risk from. Focus on the occupation of your consumer and industry sectors for your business exposures. Think about the location of these exposures and the likelihood of a potential turnaround. For example, a tourist operator in Cairns will have a far turnaround than one that is based in Sydney. If we look at the third consideration, acknowledgement of the unknowns. You do not need to include all of these. There's quite an extensive list there, but some areas are obviously going to influence your judgment in terms of potential impact on your loan portfolios if they're not addressed. So I guess, center of mind there, deferral requests. We know that already there's been over $153 billion and 429,000 mortgages. A lot of those requests, people are going up subsequently and said, actually, we don't want to move forward with the deferrals. And also, in 6 months' time, when those deferrals come off, a lot of people aren't going to be in a position to necessarily pay. There's people tapping into super accounts, that's masking a lot of the impact as well, along with, the government support. And that support may not be extensive into the future. So what you're looking at today in terms of the macro picture could be very different in 6 months' time, and you need to take that into consideration. Potential for a second or third wave. You look at the Spanish flu in 1918, no one really knew until it was over 2 years later. So estimate the impact of some of the above indicators against your base versus downtime scenario. So COVID goes up both short-term and long-term modelling for the expected credit losses. Therefore, your model needs to be flexible enough to do a rigorous scenario analysis and isolate industries, occupations that your portfolio has high exposure to. What weightings will you apply to your downturn or severe downturn scenario based on your head testing results? You need to give consideration to those things. So this brings to life, this diagram brings to life what we've discussed. You can see a SME segment. You can see the economic sectors that segment relates to. And you can also look at the risk factors that you think are inherent to that economic sector and segment. What are the cash flow assumptions in terms of when you're going to be repaid? You also look at the macroeconomic scenario, government support, what is actually happening in terms of currency, housing prices, and GDP growth. And then you need to actually model that in terms of the sensitivities and also look at the stress regulations, so loan deferrals and that sort of stuff. Don't just look at it from a provisioning perspective. You need to build the model when you're still looking at your capital, your earnings, and liquidity. So going back to what Apple is referring to for the large ADIs, taking that holistic view of what your stress testing approach is going to be look like. David, over to you. I think.
So, give me a question. What, David? So, there obviously is quite a lot of pressure on insolvency coming up with some of those law changes. But because there'll be a poll question will come up on the screen right now. If you could just answer that, we'll sort of share those answers at the end. Do your systems accommodate modelling of the government support measures? For example, payment deferrals, both current and future. A, no. B, yes, for current payment holidays. And C, both current and future payment holidays and scenario based. Thanks, David. We'll let that poll close in on the side if you want to keep going.
Thanks, David. So in terms of the bank assumptions, what do the banks use in terms of their half-yearly results and announcements that they've made? So we've done some analysis over those. By far the majority of banks, including the second-tier banks, have limited the key macro variables to 3 or 4. Macquarie had some additional ones due to the complexity of their business and exposures to commodity fluctuations, but by and large, it was GDP, unemployment numbers were broadly in line with what the RBA had forecast over the short to medium term. So across all the banks, they were relying a lot on what the RBA forecasts were. There's another link down there that I've provided for trading economics and indicators. There didn't appear to be a lot of deviation across the banks in those macro views, and also in terms of what their long and short-term views were in terms of the intensity of the downturn and the duration of the downturn. The majority of the banks use 3 scenarios, a base case, then a downside or severe downside being the main approach. Then each of these scenarios is probability weighted. An obvious factor considered by the banks was the duration and of the lockdown and expected time to recovery post-lockdown. RegCentric was the only bank that actually showed what weightings they had applied to each of the scenarios, with 40% being a further downside scenario. So we'll move on to the next slide. I think this brings us to life in terms of CBA. I took that from their third quarter announcement. And you can see that a lot of the factors there I've spoken about, the bottom-up analysis, looking at a granular assessment of the likely stress at customer, industry and sector level, the top-down judgments that they've used in terms of the multiple economic scenarios, the downturn and the prolonged downturn scenarios, and then the unknowns. So the duration of the restrictions, both domestically and globally. Benefit of unprecedented fiscal, monetary, prudential and private sector response and how long those are going to last for. So even though we're doing a scenario analysis, the macro factors they are also doing granular portfolio stress testing. Then they're weighting their scenarios to form a view on their COVID-19 position. So move on to the next slide. I thought this would be interesting to have a look at because it shows some of the challenges of forecasting. The graph on the left sources wages and salaries data into CBA bank accounts. It helps identify the level of employment, wages growth and hours worked. Noting that it also shows the JobKeeper payments from the ATO. In April, the rate of wage growth dropped to be down 3% year on year, but did recover to be just 0.5% over the year. This is different to the GFC, where job losses were from high income sectors. People received significant redundancies, not just job seeker. So a lot of people were able to pay out their mortgages back in those months. So look at this, the type of jobs that have been lost matters when considering the shock to income. Australia, during this pandemic, has lost a disproportionate number of lower income casual jobs in hospitality and recreation. This means that the hit to wages and salaries bill is less than the change in jobs. So look at the graph on the right, which is sourced from SEEK, showing the level of job advertisements. Fewer ads means there are fewer businesses looking to hire. While April unemployment numbers revealed a jump in unemployment from 5.2 to 6.2%. The fact is that all employers received the government's JobKeeper with subsidy were counted as employed even though they didn't work any hours. The participation rate fell to its lowest level in 16 years, from 66% to 63.5%. If the participation rate had remained unchanged, the unemployment rate would be over 10%. So I'm just trying to highlight from these two graphs that you need to look in behind the numbers when you're doing your forecasting and understand how that's going to impact your industry and your sectors and the people that you're banking. It will be interesting to follow these over the next 6 months. So if we look at the impact of smaller banks with the Great Lockdown, we know firsthand the pain that smaller ADIs are encountering across all areas, manual spreadsheets, limited and competing resources across all areas of business. Sourcing data quickly with limited accounting, finance, risk and IT development resources to be able to adapt to the requests from the regulator is a challenge across the board. Competing resources in an already cost-constrained environment, you need to think about your response to COVID-19 and AASB 9 priorities and resources now, not in 6 months' time. All ADIs are already seeing a significant increase with requests for COVID-19 data. Last week, APRA released templates and guidance on submissions due the 15th of June for April and May data. An automated model for ECL, where you can break down your risk-weighted assets into stage 1 through to stage 3 will be imperative. Granular data analysis across what is included in your stage 1 to 3 categories will not be able to be done accurately on spreadsheets. As you move through COVID-19 crisis, the volumes are going to increase in your stage 2 and stage 3. It's going to require a lot of focus. The next slide, we're talking about what sectors are likely to come under scrutiny in stress testing scenarios. So COVID-19 is not only transforming the request for information from regulators, but also having an appreciation to be able to analyse your exposures to a granular sector level. It's going to be paramount in the way that you manage your business and manage your risks, and therefore determine what your expected credit losses are going to look like. I've tried to highlight here some of the industries that we've seen a deterioration in. So some of the obvious ones, hospitality, event management, retail, and the travel industry. And then we've also seen an uplift in retail, healthcare services, Obviously, a lot more people were doing things from home, so home office equipment, home gym, entertainment equipment. We're seeing a shift, dramatic shift between those sectors where we've seen a deterioration and an uplift in those other sectors. So you need to overlay that into your analysis. And then you need to also consider what sectors will recover the quickest. Having an appreciation to be able to analyse exposures to a granular sector level is going to be paramount. More importantly, understanding your customer and industry exposures to determine and then predict what segments you think will recover the quickest. There are obviously going to be sectors like tourism. They're going to have high lead times to recover, whereas restaurants and small event management are likely to recover quickly. I've also included a graph that I saw from Accenture, and this is quite interesting when you look at the expenditure that was taking place leading into the lockdown, and then as the lockdown started to bite. Sort of supports a lot of the conclusions from the previous slide, but I thought I'd share this because it does highlight the spending patterns. I guess you can home food delivery, being the one down the bottom, at 230% growth. But the interesting is follow these spending patterns in coming months to see how these things evolve as restrictions are eased. But more importantly, providing some insight into those sectors that are likely to continue to suffer under COVID-19. So you can follow Accenture to actually get updates on that, and if you want us to build it into a view on your models, it's well worth following. So does that bring us on to our second question?
Yeah, I can see the buses aren't running well on looks of it, but obviously they are still. It's just not catching them. Nice time to catch a ferry across the harbour in Sydney for sure. Are you able to flexibly define sector-based segments on top of risk models and a run simulation to enable stress testing using sector-based lag activities, etc.? Box to the right, A, yes, but it will require IT resources, which would take 1 month to complete or more. C is yes, and it will require IT resources, which would take less than 1 month to complete. And D, yes, we can do it today. Again, the answers will be shared at the end of the session. Thanks, David.
Thanks, David. So let's take a brief look at capital management. APRA released guidance to boards in April 2020 reflecting their expectations on capital management. APRA expects ADIs will take a forward-looking view on the need to conserve and use capacity to support the economy. This includes the level of collective provisioning by banks. There's a trade-off here on whether adequate provisioning will be achieved while maintaining a capital buffer. Stress testing supports these views and giving you due consideration to plausible downside scenarios. This will require ongoing iterations with the model as more information comes to light on what is happening in the economy and COVID-19. It's likely you will need to run multiple scenarios between now and the end of the year to firm up your views on what is going to be adequate provision. Initiate prudential capital management in response, a preemptive basis to ensure they maintain the confidence and capacity to continue to lend and support to their customers. So touching on the key elements that they looked at. Deferred dividends, preserving capital buffers. Being able to prove to APRA that your stress testing is robust enough. Ensuring you're able to adequately explain the scenario and probability weightings applied to each scenario. You can see the underlying theme that the stress testing, as mentioned earlier, will flow into all elements of managing the business. So again, talking about that holistic view on dividend policy, liquidity, capital preservation, leverage ratios, remuneration. It's not just about provisioning, although it's a critical part. So what have the banks done on capital management? Banks' earnings in the first half of 2020 fell below $9 billion for the first time since the GFC, and return on equity fell below 7% for the first time since the 1990s. So if anyone remembers the 1990s, a lot of the banks almost went close to the wall. That's how close things are now. Approximately $6 billion in COVID-19 charges have already been booked by the banking sector. Bendigo being the latest on Thursday last week, taking up 148 million. It's almost certain that there will be another round of large provisioning in the second half of 2020. You can see the majority of the banks have elected to defer their dividends until they can satisfy the regulator that they can maintain their capital, as evidenced through their stress testing scenario modelling. There's no immediate timing on when they will resume paying dividends. You can also see that most of the banks are looking for ways of releasing capital through exiting wealth and life insurance businesses. A lot of those banks have been looking at that over the last 3 to 4 years. So not a new phenomenon, given several sales have already been completed. So moving on to a summary. The initial pandemic-related economic losses will take time to crystallise. For banks to continue playing a positive role in the supply of funding during the recovery, they will need to maintain usable buffers for a long period. As losses from a severe recession will take time to materialise. As we've seen with the range of forecasts by banks, it is likely there is no exact answer to what are adequate provisions in this environment. The level of adequate provisioning is complicated by government supporting initiatives, loan deferral arrangements, and support from the private sector utilities will mask the extent of the downturn. It's obvious loans that have been deferred will need to be repaid at some point in the future. AASB 9, as outlined, does provide some flexibility in its approach on the adequacy of provisions. APRA and auditors alike appear to be adopting a flexible approach in applying AASB 9, while preserving the financial system's soundness and transparency. It is clear APRA faces different trade-offs as the Australian economy and banking sector faces the most severe economic crisis in living memory, unless you're lucky enough to be over 100 and survive the Spanish flu. Stress testing models, assumptions and determining a benchmark scenario will be paramount in navigating through this crisis. The insights from your stress testing will flow into every aspect of your banking business. In capital management, it's not just about determining expected credit losses. Understand your loan portfolios and the underlying exposures. Stress testing should be supported by an automated solution that is capable of providing timely and reliable scenario analysis and real insights into the running of your banking business. So where to now? Banks will continue to walk their tightrope between managing a capital buffer to abide by the regulator while maintaining lending in an environment with significant net interest margin compression. We're also having to adjust their business and operation models to accommodate the changing COVID-19 environment. It will be critical to implement robust automatic stress testing models that are capable of providing insights across your loan portfolio to manage your banking business through this crisis. If you haven't already, consider this is now the time to do it. So using a famous analogy from Donald Rumsfeld, we know COVID-19 has far-reaching implications for everyone. We don't know when a vaccine will be available, but we know we need one. And we don't know whether there is going to be a second or third wave of COVID. We do know, however, not to underestimate the importance of an automated stress testing solution and the value that this will bring in managing all aspects through this COVID-19 crisis. Thanks very much.
Thanks, David. It is interesting with APS 220 on hold. I think you're right. A lot of these organisations, and we'll talk about the questions and answers as well here. It's important to make sure that we're able to flexibly meet these changing times. This will be one of many things over the next 100 years, I'm sure, which will unfold, which will impact portfolios, and with banking changing so much with competition and deregulation across borders, and obviously Bitcoins and other different currencies and things that are out there, it's only going to get more challenging over time to make sure that banking executives are on top of these numbers. So thank you, David, for your commentary today. We did say we come back to the questions from earlier. So the first one was, do the systems accommodate modelling of the government support measures? We got an overwhelming no score on that one. So there was a couple of answers to yes, it does cover payment holidays and cover current and future payment holidays, but I think the answer would suggest overwhelmingly that it is quite difficult to accommodate the requirements that are currently putting pressure on systems. So that was the first answer to the first question. David, did you have any comment on that one at all?
No, I think look across, particularly the second tier ADIs, we're seeing that a lot of stress testing is run off spreadsheets. A lot of extracts coming from a lot of manipulation of that data to come up with a scenario analysis, and it's not the sort of thing that you can continue to run on spreadsheets into the longer term, particularly where there's so many fluid scenarios coming into play with COVID-19. As I said, we don't know if it's going to be a second or third wave. The global community, we don't know how long the lockdowns are going to persist in some locations. It's impacted supply chains across the banking sector. So the more that you can look at automating and building a rigorous and robust model, the better it's going to be.
Yeah, great. And that's also similar to the other question that was asked during the webinar as well, David. Are you able to flexibly define those sector-based segments on top of risk models and run simulations? And yeah, the answer there was obviously similar, and that was that it was overwhelmingly no, it was difficult. But there were a few outliers on that. So how those organisations are doing that, I'm sure they'd love to share on our blog, on our website. Yeah, okay. Look, we haven't got any questions through the right-hand panel. If anyone did have any questions they'd like to ask David, please feel free to drop them through at this second. I'll give it a little bit. Yeah, we're not having any questions so far. So what we'll do is we'll look to wrap up, which is great. We'll give you an extra few minutes in your day. So look, thank you very much for attending today's session, and thank you, David, for talking and giving us a commentary on how COVID-19 is impacting provisioning. Obviously, RegCentric are working in this space very hard with our team. Our team members are working with a number of ADIs and RFCs and other financial services to help them with their data and their financial reporting and their risk reporting. We definitely pride ourselves on that aspect of business with quite a large team with a broad experience base. So if there's anything that you'd like to contact our team on, please see the address and the information on your screen right now. You can contact us on our website at www.regcentric.com, or you can email info@regcentric, or you can call one of our team on the number on the screen there, 02 8091 7187. We do have a blog going on our website for BCBS 239. We think that that will be the next focus down the track. Obviously, with some deferrals of regs coming in for banking organisations, there will be quite a big leap and a big jump to get all of that done through the new deadline. So if you need any help, please let us know. And please feel free to download the white papers and rewatch this video or watch other videos like this on our website, and refer us to any of your peers if you like what you see. Thank you again, and we look forward to being in touch with you and supporting you through this and many other challenges you'll go through in future. Thank you.